Okay, and we'll just give everybody a minute or so to join. Okay, we're at 12:01 Central, so let's just go ahead and get started. So thanks everyone for joining us today for this year's year-end planning webinar for individuals and families. So we have a lot of great info for you, so let's hop right in. And so from planning to preservation, tax strategies for 2026 success. So what it's going to help you do, it will help you evaluate how the latest legislation affects your 2025 tax position. It'll help you anticipate TCJA sunset impacts and prepare for future tax shifts. Create a tailored plan that protects and enhances your long-term financial outlook, and maximize charitable giving, investment, and estate strategies before year end. And we have two great presenters today. We have Jonathan March and Debbie Van Dieven, and I will go ahead and let them introduce themselves, and then we'll get started.
Good afternoon and good morning to those joining. I'm Jonathan March. I'm a partner here at Armanino in our private client advisors tax practice, and I am located in Dallas, Texas.
And I am also a partner in our private client advisors group. I am in our St. Louis office, and I also head up our St. Louis tax practice here. And I think I am going to jump right in with there we go, with the most impactful legislation, tax legislation that we have had in 2025 so far, and that is the One Big Beautiful Bill Act, which we refer to as OBBBA. So when you hear me say OBBBA throughout the presentation, that is what I am referring to. So one of the most important things that OBBBA did for us was make permanent many of the TCJA provisions, and that's the Tax Cuts and Jobs Act from 2017. Many of those provisions were due to expire at the end of 2025, and if that had happened, most taxpayers in the U.S. probably would have seen an increase in their tax bill as we headed into 2026. Because there were several things in TCJA that lowered taxes for American taxpayers, but probably the most impactful was that the individual tax rates were lowered across the board and the brackets were increased. That meant that you weren't hitting those higher income tax brackets until a higher level of income. For instance, prior to the TCJA, you were hitting that top 39.6 tax bracket, and when you're married filing joint, in the mid 400,000s. After TCJA, you were not hitting that high tax bracket, which was reduced to 37%, until you were in the mid 600,000s. And those brackets and rates were increased and the rates were decreased across the board, so that almost all taxpayers saw a reduction in their tax bill as a result of the TCJA. What was also made permanent was the increased standard deduction. Prior to TCJA, that was around $6,000 a person. It was increased to $12,000. And so for a married filing joint couple, that deduction went from $12,000 to $24,000. And that meant that millions of Americans no longer needed to their deductions. It made tax filing simpler for millions of people. As part of that bill and as part of OBBBA, now permanently are repealed exemptions, the personal exemptions that people used to take. And that was a $4,000 or so a deduction that you would get for yourself, your spouse, and your dependents. We no longer have that. I think with the increased standard deduction, that largely compensated for the loss of the repeal of the exemptions. There are also miscellaneous itemized deductions were permanently repealed under OBBBA. And miscellaneous itemized deductions are those things like investment expenses, tax preparation fees, unreimbursed employee expenses, and they had, to the extent that they exceeded 2% of your AGI, you could deduct them prior to TCJA, but no longer. And that is a permanent change. The only deductions that are really deductible now are educator expenses and unreimbursed moving expenses if you are in the military. A new concept that was introduced in the TCJA, which is now made permanent, is the excess business loss limitation. And this limits your losses in any one year. For 2025, that limitation is $626,000. That's the most that you can write off on your business losses. So for example, say, you're invested in several businesses or one business, a startup, you lose $1 million in year one. You can only take a deduction for that of $626,000. But the differential, the $374,000, is not lost. You do get to carry that over as an NOL indefinitely, and it can be used to offset 80% of your taxable income in future years. And the cap on the mortgage interest deduction is so permanent now, and that limits your home mortgage interest deduction for acquisition indebtedness of up to only $750,000. I often get asked if home equity line of credit interest is deductible, and it is if it is used to buy, build, or substantially improve your main or second home, and it does not exceed that total $750,000 of debt limitation. The OBBBA also provided us with tax provisions. And the first two that I'm going to talk about were often brought up on the campaign trail, and that was eliminating taxes for tip income and overtime pay. Now, they were not completely, taxation on those is not completely eliminated, but there are large deductions. For tip income, a taxpayer can deduct up to the first $25,000 in their tip income. And for overtime pay, a taxpayer can deduct up to the first $12,500 of their overtime pay from their taxable income. These are eligible in years 2025 through 2028, and they are phased out when AGI start to get phased out when AGI exceeds 300,000, and they are fully phased out when you are at $550,000 AGI. Given that most people that are receiving tip income or overtime pay likely are, on an hour, I don't think that those limitations are going to affect too many taxpayers, and most people that do receive tip income and overtime pay hopefully will be able to take full advantage of these deductions. Another one that I get asked about a lot is this auto loan interest deduction. We have not seen auto loan interest deductible, I don't think, since the 1986 tax law changes. And there is an available deduction of up to $10,000 for auto loan interest. However, there are many limitations on this. First, your auto needs to have been purchased in years 2025 through 2028. And the final assembly of that auto needs to be in the United States. And more importantly, this deduction is phased out for married filing joint when your income exceeds $200,000. And by the time you are at $250,000 AGI, the deduction is fully phased out. So there will be millions of taxpayers that will be able to take advantage of this deduction. But if you are a high income taxpayer, it is unlikely that you will be able to. There is a new deduction for seniors, $6,000. And for this purpose, a senior is defined as someone who is 65 or older. The deduction is available for the years 2025 through 2028, but there are income limitations on this also. The deduction is reduced by 6% of your AGI that is over $150,000. So by the time you're at $250,000 of AGI, this deduction is fully phased out for you. There is a new floor on charitable contribution. It's a 0.5% floor that you cannot deduct the first 0.5% of your AGI as a charitable contribution. So if your AGI is $1 million, you cannot deduct the first $5,000 in charitable contributions. Jonathan is going to cover this more when he discusses charitable giving, so I'm going to let him go into detail. They have also capped the benefit of itemized deductions at 35% beginning in 2026. And typically when you have a deduction, an itemized deduction, you're getting the benefit of that deduction at your marginal tax rate. So if you're in a 24% tax bracket, you're getting the benefit of a deduction at 24%. However, now if you are in the top, if you're in the marginal top tax bracket of 37%, you're going to have to take a 2% haircut, and you'll only get the benefit of your deductions at 35%. There are also some tax provisions that were enhanced under OBBBA. And the first is the state and local tax deduction. Under the TCJA, state and local taxes were limited to a $10,000 deduction for married filing joint tax return. Under OBBBA, that limitation is now increased to $40,000. It's increased to $40,000 for years 2025 through 2029. However, if your income exceeds $500,000 as married filing joint, then the increased deduction is reduced, and it is fully phased out by the time you are at $600,000. However, the deduction will not be reduced to below $10,000. So if your income is over, your AGI is over $600,000, unfortunately, you don't get to reap the benefits of this additional deduction. But there are clearly many taxpayers under the $500,000 AGI threshold that will be able to take advantage of this increased deduction for state and local taxes. They've also added new opportunity zones. Now, an opportunity zone was something that was introduced in the TCJA. And the benefits of investing in an opportunity zone were if you had capital gains in any year, you could take those capital gains and invest those in an opportunity zone fund. And by doing so, you could defer recognizing gain until 2026 or until you sold that investment in the opportunity zone. So they've created all of those zones were due to expire in 26. So they have created new zones. Governors can designate new opportunity zones. They're typically economically distressed communities. So they're trying to encourage investment in those type of communities. And the new zones will begin in 2027. And if you invest, you can defer your capital gains that you invest in those until 2033 or until you sell. And if you hold on to that investment for 5 years after the investment is made, you can exclude 10% of your total gain when you exit the investment. Or if there are new rural opportunity zones being introduced now, and if you hold an investment in a rural opportunity zone for 5 years, you can exclude 30% of your gain. As is typical with most years, there are many tax thresholds that are adjusted for inflation adjustments. I'm not going to get into all of those. Those are the tax rate brackets, your RMD, your contributions to retirement plans, those kind of things have thresholds. And in general, the inflation threshold increase for 2026 is those thresholds will go up about 2.7%. So what can you do now? So you can bring your 2024 tax returns and your 2025 income and investment summaries to your tax advisor or your wealth advisor, and you can review your income and your AGI and see if you're bumping up against any of those thresholds. And you can identify if there's anything that you can do to change some of those, your income amounts. Now I'm going to discuss like the timing of this, and this is what you would want to discuss with your wealth advisor. Can you move the slide, please? So timing definitely still matters. The traditional advice is that you want to defer income and you want to accelerate deduction into the current year, because a tax dollar delayed is a tax dollar saved. And that is advice that often works, but not in every circumstance. So when would you know if deferring your income into a later year is the right answer for you? You might want to look for opportunities to shift income into 2026, for example, if you can. For example, you might be able to defer a year-end bonus. You might be able to invoice your clients or your customers, into early 26. Or if you're going to have an asset sale, you might be able to defer that. I know that a very common strategy is, I know when we have clients that are selling a business, they might decide, that they want to close at the end of the year. We're going to do that closing on December 31st. But if you actually would defer that sale by 1 day and move that into January 1, you can delay paying the tax for a year. So this strategy can allow you to postpone paying your tax on that income to next year. And that could be especially beneficial if you expect that you're going to be in a lower tax bracket, or you want to stay under some AGI threshold. And when would you want to accelerate deductions, and when does that make sense? You can consider pulling all expenses that you can into 2025. With the charitable giving rules changing in 2026, with that 0.5% floor, you might want to move some of that giving into 2026, because this might be the last year that you can fully benefit from some of those contributions. If you itemize, you might accelerate some of your deductible expenses like medical expenses or interest, and and again, making some of those charitable contributions in this year. But sometimes the reverse is actually true. Depending on your financial situation, it may be more beneficial to take the opposite approach and accelerate income into 2025 and delay your deductions into 2026. And this could apply if you project that you're going to be in a higher tax bracket next year, or you know that you have, a big income item that's going to hit in 2026, which is going to spike your income. You might want to push some of that income into 26 and delay the expenses into, push the income into 25 and delay the expenses into 2026. And sometimes a balanced approach is the best way to go. If you may want to spread your income and deductions across 25 and 26. This could help you avoid some income spikes that might trigger some surtaxes or some AMT exposure or deduction phase outs. And with OBBBA introducing some new tax thresholds, a multi-year strategy sometimes can help smooth out your taxable income and preserve more of those deductions for you. And I think we have a short polling question now.
Thanks, Debbie. Yeah, so our first polling question. So how confident are you that your current tax and estate plan is optimized for the latest 2025 rule changes?
I'm sorry. That's my bad on the polling.
That's okay. Oh, a different one.
It's this
So
one.
there we go.
Sorry. I'm sorry.
That's
My
okay.
bad.
What's a webinar without a little bit of technical difficulty? Perfect. Just kind of giving everybody a chance to answer there. Okay. Okay. Still have a couple people answering. I'll go ahead and end that, and then we'll keep moving.
Okay, I'm going to briefly discuss some of the tax thresholds for 2020 and where we're going to end up this year. OBBBA made the TCJA's rate structure permanent so that the top marginal income and capital gains tax rates remain unchanged for 2025. But inflation rates have shifted those income thresholds and the brackets. So I'm going to, kind of point out where you're going to hit those highest tax rates. So the top marginal income tax rate is 37%, and when your taxable income exceeds $751,600 for marrying, filing joint, you're going to be there. And when in that bracket, and when you are at $626,350 for single, you're going to be in that top marginal 37% tax bracket. There are three different capital gains rates. There is the 0% tax rate, there is the 15% tax rate, and there is the 20% tax rate. And you are going to be in that top 20% capital gains tax bracket when your income exceeds $600,050 if you're married filing joint, and $533,400 if you are single. And we cannot forget the net investment income tax. If you are a top earner, you may owe an additional 3.8% net investment income tax. And this tax could apply to some or all of your net investment income if your AGI exceeds the applicable thresholds for your filing status. And for 2025, that is $250,000 for married filing joint, and for $200,000 if you are single. And there is also an additional Medicare tax. You'll be subject to an additional 0.9% Medicare tax if your wages exceed those same thresholds, the $250,000 for married filing joint and $200,000 for single taxpayers. And that Medicare tax is payable by you. It is not payable by your employer. That is a tax that the employee bears. And what can you do now? You can review your unrealized gains and losses with your wealth advisor. If it's a good time to reposition or rebalance your investment holdings at year end, that might help mitigate some of your, if you have some large capital gains, offset that so that you can minimize the capital gains tax that you will pay in 2025. The next thing that I'd like to discuss is retirement contributions and RMDs. Maxing out your retirement contributions is still one of the most effective ways to reduce your taxable income and to build long-term wealth. And anyone with taxable compensation can contribute to a traditional IRA. The limit is $7,000 for 2025 and $8,000 if you are 50 or older. However, if you have access to a retirement plan through your job, then you will not be able to deduct these contributions if your income exceeds certain thresholds, which is $89,000 if you're single and $146,000 if you're married filing joint. I think the misunderstanding here is I think a lot of people think, oh, I've contributed to my employer retirement account, so I cannot make a contribution to a traditional IRA outside of my employer plan. That is not accurate. Anyone can make a contribution to a traditional IRA if they have employment earnings. It just might not be deductible. But you can also make contributions to a Roth IRA or a Roth 401k, but those contributions are never deductible. This means there's no immediate tax benefit, no tax deduction. The payoff for these comes later because qualified Roth distributions are completely free from federal income tax. You can contribute directly to a Roth IRA in 2025. However, I find that a lot of our clients cannot because they exceed the income threshold for making that direct contribution. And if your AGI is over $150,000 if you're a single taxpayer, or $236,000 if you are a married filing joint taxpayer, then you cannot make a direct contribution to your Roth IRA. You may, however, still be able to make it through your employer plan. So for 2025, you can contribute $500 to your 401k, 403b, and your 457b plans. You can contribute $31,000 if you are 50 or older. And there is now, this was in Secure 2.0, I believe, there is a super catch-up. If you are ages 60 to 63, you can contribute an additional $3,750, making your total contributions to your 401k type plan $34,750. And these are going to be increased for 2026 by $1,000. So, $24,500 or $35,750 if you're in that super catch-up area. You can also make a contribution to a simplified employee pension plan. Also, most people refer to these as SEPs, but SEP plans have wage-related limits rather than contribution limits. So you can contribute up to $70,000 or 25% of your eligible compensation in 25, whichever is less. And for sole proprietors, which is where we typically see these SEPs, the 25% calculation is based on your net self-employment income. Now, required minimum distributions are the amount that you must withdraw annually from your retirement accounts each year after you reach the required age. And the required age in 2025 is 73 years old. So if you are 73 years old or turning 73 in 25, you will need to take our RMD from your traditional IRA or 401k. The penalties can be pretty stiff. If you do not, they were reduced under Secure 2.0, I think, but that penalty can still be up to 25% of the missed RMD. Roth accounts, however, are not subject to RMDs. Original owners of a Roth IRA or Roth 401k or 403b are not subject to lifetime required minimum distributions. So you can leave the funds in that account for as long as you like. You don't even need to take any distributions in your lifetime. However, if your beneficiaries inherit the Roth IRA, they will be subject to RMD rules. And the RMD rules for inherited retirement accounts, whether that be a Roth IRA or a traditional IRA or 401k, are different. If you inherit one of these accounts, you are required to deplete the entire account within 10 years. So if you are taking Roth distributions, you can take them annually, or you can wait until year 10, let those keep growing tax-free, and you will never pay any tax on that. However, if you inherit a traditional IRA or 401k, and you are also required to take that out, all of it by the 10th year, if the owner of the deceased, the person that you inherited the IRA from is deceased and has started taking RMDs because they had achieved the age at which they need to do that, You will also need to take annual RMDs on that inherited IRA, but it is based on your life expectancy, not that of a deceased taxpayer, and you still need to get it all out within 10 years. What can you do now? So I think the important thing to do is, check your age, just check with your wealth advisor, make sure that you're taking all of the RMDs that you need to take now. And also you want to make sure that you're maximizing your retirement accounts. You can discuss that with your wealth advisor or your CPA.
And Debbie, there was a question came through related to this slide that I just wanted to go ahead and ask now. So if my employer contributes to a SEP IRA, can I contribute to an IRA myself?
Yes, you can.
Okay.
Yes.
Thank you.
It likely isn't deductible, but you can. Okay. So can you move the slide, Haley? Thank you. So given the benefits of a Roth, that all the tax dollars, all the dollars that come out of that in retirement are tax-free, many people consider converting their traditional IRAs or 401k to a Roth. And if you do that, you will pay more taxes now when you convert your traditional IRA to a Roth or your 401k to a Roth 401k. The amount that you convert is typically fully taxed as ordinary income in the year of conversion. This doesn't apply to any non-deductible contributions that you might have had in these accounts, but in my experience, the amount of non-deductible contributions is usually minimal compared to the overall traditional IRA or 401k. But sometimes taking the one-time hit can be a smart move, because once those funds are designated as a Roth account, all qualified withdrawals are tax-free, and it can continue to grow tax-free throughout your lifetime. So, but the timing of making that conversion really can be critical. So I just wanted to briefly discuss, when does it make sense to do a Roth conversion? And what considerations should you look at? So things that favor a Roth conversion and doing it currently is if you believe that your tax bracket is going to be the same or higher in retirement, then paying taxes now at a later rate can certainly save you money down the line. If you want to avoid having required minimum distributions in retirement, possibly because you don't think you're going to need those funds in retirement and you're going to be forced to take them at age 73, that might be another reason that you would want to do that, because the Roth IRAs have no lifetime RMDs, and that gives you the flexibility to let those assets grow tax-free indefinitely and let your heirs inherit that IRA or 401k. And if you have a long time horizon, if people are older in their journey, maybe more in that 80 plus category, it's unlikely that we would advise you to convert to a Roth. But if the longer your money stays invested, the more tax-free growth you enjoy. So conversions make the most sense if you don't need the funds for 5 years, and and can let them, and you have no intention of taking those dollars out for that 5 to 7 year kind of time frame. And it's also ideal if you can pay the taxes from non-IRA funds. The conversion amount is taxed as ordinary income in the year of conversion. So using outside funds to pay the tax bill preserves the assets in that Roth account and provides for tax-free growth in the Roth. So also, if you're in a low income year or you have some market downturns, if you can convert in a year when your income is low, or you have like NOL carryovers that you're bringing into the current year. I know I've had a client who was pulling about $500,000 of NOLs into his 2024 tax year, so chose that year to convert his Roth, and he didn't pay any taxes when converting that Roth. And also many advisors, as well as I, partial conversions. You don't want to have a big conversion and bump yourself up into these high tax bracket, but you might want to have a 5-year plan where you convert. Maybe you can stay in a lower 24% bracket over 5 years with smaller amounts being converted each year, minimizing the tax that you're paying on that conversion. And when doesn't a conversion make sense? If you expect to be in lower tax brackets in retirement, keeping funds in a traditional IRA might be the better answer for you. Or if you're going to need that money soon, early withdrawals could trigger some penalties. So you probably want to stick with your traditional, and keep in mind that those large conversions can push you into the higher tax brackets, and they can increase your Medicare premiums or phase out some of your deductions. So you might want to avoid a conversion in those circumstances also. There's just a couple more topics that I wanted to touch on. And that is several of the Secure 2.0 provisions that affect how Roth accounts function within retirement plans. And I think that there is a change to the 2026 that I think many taxpayers are unaware of. So, and that is the mandatory Roth catch-up contribution to begin in 2026. If your prior year wages exceed $145,000, so that means if your 2025 wages exceed $145,000, any catch-up contributions that you make, these are the contributions that you make when you're 50 and older, they have to be designated as Roth contributions. That means you can make them, but you're not going to get a tax deduction for them. And so this applies to 401ks, 403bs, 457b plans. And plans that don't offer a Roth contribution option are going to be restricted on the catch-up contributions that people may want to make. So you're either going to be restricted, or those plans have to be amended to allow for those catch-up contributions to be made as Roth contributions. Also, 529 plans, these are the 529 are the education plans. You've put money aside for your children or your grandchildren. Let's say they've graduated from college now, and you have overfunded this 529 plan. If you are the beneficiary of a 529 plan, you can roll that amount over into a Roth IRA. You can do that tax and penalty free, up to a lifetime limit of $35,000. There are some limitations on this, though. 529 account must have been in existence for 15 years. Contributions made in the last 5 years won't qualify. And the rollovers are still subject to the annual Roth IRA contribution limit, which is at $7,000. And the beneficiary must have earned income equal to the amount of the rollover. And so what can you do now? You can run some side-by-side scenarios for a Roth conversion, see if it makes sense to convert some of those dollars, or if it makes more sense for you to just let it stick in your traditional IRA and grow that way, and then be subject to the traditional IRA rules, which require the RMDs when you reach age 73. So that is all I have for now. I'm going to let Jonathan take over.
Thank you, Debbie. Okay, so we're going to switch over to charitable giving strategies. So for many families, giving to charity is an important part of their family values. The impact of making a charitable contribution to a charity helps others in your communities, helps create a family legacy, and can reduce your income tax liability through a tax deduction. In 2025, the charitable contribution deduction is still available to offset your income up to a 37% tax rate. So let's explore some charitable strategies. So first, let's consider the difference between making gifts to charity of cash versus appreciated assets. So by making cash contributions to charity, you can deduct up to 60% of your adjusted gross income as an itemized deduction on your 2025 taxes. So this reduces to 50% of your adjusted gross income if you also gift any appreciated assets. So by gifting appreciated assets to charity, you can deduct up to 30% of your adjusted gross income as an itemized deduction on your 2025 taxes. Although the adjusted gross income limitation is lower on giving appreciated assets, the potential income tax savings is quite notable. So by giving an appreciated asset like NVIDIA stock, you get to take the fair value of the stock as your charitable contribution deduction. It's not your cost basis in the asset. So you are also not taxed on selling the asset as a realized gain if you donate the appreciated asset. So you do not pay the capital gain tax on the sale of the appreciated asset, and you get a fair value deduction on the date you transfer the asset to the charity. It's a win-win. I do want to add the caveat that in order to get the fair value deduction of donating appreciated assets like stock or artwork, you must have held the asset for at least 1 year and 1 day, which is a long-term holding period. Short-term holding periods have different, less favorable rules for the amount you can deduct. So let's move on to some other charitable vehicles that you can utilize to increase the impact of your annual charitable giving. So a donor advised fund is an account that you can make gifts to and receive the charitable contribution deduction in 1 year and grant the funds to public charities over time. In other words, you're able to time your charitable contribution deduction into a high income year and fund the gifts to charities over a more measured period of time. Gifts to donor advised funds have the same adjusted gross income limitations as donating directly to a public charity, which is 60% for cash and 30% for appreciated assets. So this is a great tool to use if you are considering bunching or accelerating tax deductions into 2025 ahead of the changes in the tax law impacting charitable contributions under the One Big Beautiful Bill Act that Debbie was talking about earlier. Next, a private foundation. It's a great tool to fund and create a family legacy that will begin with a much larger gift than to a donor-advised fund. Usually $5 million or more is an initial funding that makes the most sense for these more complex vehicles. Adjusted gross income limitations for gifts to private foundation is lower than gifts directly to public charities or to a donor-advised fund. So for a private foundation, your limitations are 30% for cash gifts to the foundation and 20% for gifts of appreciated assets. Private foundations have additional administrative burdens that gifts to a donor-advised fund or gifts directly to charities do not have. So the annual tax return is publicly available and it discloses the assets and income generated in the foundation. There is also an annual distribution requirement, which donor-advised funds do not have. And there is a 1.39% minimum excise tax due on the net income generated in the foundation. Moving on to charitable trusts, there are two options for that. So first, charitable remainder trusts. So these trusts where you donate or appreciated assets to the trust in the initial year. So you receive a charitable contribution deduction for funding the trust in that initial year, and you receive an annual stream of distributions from the trust after that. Once the trust term ends, the remaining assets in the trust go to charity, which is generally about 10% or more of the initial asset funding. So this is a great strategy if you are looking for an annuity stream of cash while still intending to give the remaining assets in the trust to charity. The other option is a charitable lead trust, similar to a charitable remainder trust in that you donate to the trust in the initial year and receive your charitable contribution deduction. In the years after the trust is funded, charities receive annual distributions from the trust, which can include public charities, donor-advised funds, and private foundations. So once the term of the trust ends, the remaining assets are transferred to the residual beneficiaries that the trust names, either individual family members or to trusts for the benefit of family members. And this is all free of using gift or estate tax. So this is a great option. So both charitable remainder trusts and charitable lead trusts have annual tax return filings that accompany the strategy. So speak with your tax and estate advisors if either of these strategies sound like it could be beneficial to you. So next, qualified charitable distributions, or QCDs, are distributions that you can make directly from your IRA to a public charity. So by having the IRA transfer the funds directly to charity, it satisfies your required minimum distribution and it exempts the income from being taxed to you. For 2025, the maximum qualified charitable distribution that you can fund is $108,000 per taxpayer. So if both you and your spouse have IRAs that you'd like to fund the maximum QCD out of, the maximum total qualified charitable distribution would be $216,000 or $108,000 each. Interestingly, you are able to start funding qualified charitable distributions in the year you turn 70 and a half. You don't have to wait until you are 73, which is the age when you are required to start taking required minimum distributions from your IRA to fund a qualified charitable distribution. Qualified charitable distributions are beneficial if you're looking to reduce your adjusted gross income, to reduce the amount of Social Security income that is potentially taxable. It is also beneficial if you may not have enough deductions to itemize, but you still want to make a charitable contribution that reduces your tax liability. If this is something you are interested in doing, speak with your IRA administrator, which may be your investment advisor. One note on bunching of itemized deductions. This is where you make larger gifts to charity so that you have enough deductions to itemize in year one, then reduce your gifts to charity in year two so that you take the standard deduction in the second year. So this strategy may be the most impactful by funding larger charitable contributions so that you itemize in 2025, since there are new benefits and drawbacks to making gifts to charity starting in 2026 under the One Big Beautiful Bill Act. And last thing on this slide is the impact of the One Big Beautiful Bill Act on charitable contribution timing. So as a reminder of what Debbie mentioned earlier, under the Act, starting in 2026, there are two potential reducers in the amount of your charitable contribution that's deductible or the tax rate impact on the charitable contribution deduction that you receive. So first, there is a 0.5% floor reduction of the charitable contribution deduction based on your adjusted gross income. So as an example, if your adjusted gross income is $100,000 and you itemize the first $500 or 0.5% of $100,000 of charitable contributions are non-deductible. So second, if you're in the highest tax bracket of 37%, the Act now caps the tax benefit of all itemized deductions, including charitable contributions, at the 35% tax rate. So you're losing a 2% tax rate savings if you're in the 37% tax bracket starting in 2026 on all itemized deductions. So it may be beneficial to accelerate deductions, including charitable contributions, into 2025 to avoid some of the negative tax impacts of the One Big Beautiful Bill Act on charitable contributions starting in 2026. So what can you do now? So gather donation receipts and check the donor advised fund or foundation deadlines. So any gift over $250 must have a letter from the charity supporting your deduction. Physical or electronic notification is sufficient. It must include the amount or asset donated and whether or not you receive any goods or services in exchange for the gift. You should keep these letters in your files. If you are considering giving appreciated assets to a donor advised fund, start those conversations today. So depending on the complexity of the type of asset you're giving, like marketable securities, it may take several weeks or up to a month for the donor advised fund to accept and receive the gift. So start the conversation about the nature of the assets you are giving now so that the proper timelines are met to receive a tax deduction. If you are targeting to take a charitable contribution deduction in 2025, the transfer of the cash or appreciated assets must happen before midnight on December 31st. If you are mailing a charitable contribution, it needs to be postmarked on or before December 31st to qualify as a 2025 charitable contribution deduction. Your tax deduction is based on when you mail the donation, not on when the charity receives the donation. Okay, next slide, I think is a polling question.
Thanks, Jonathan. Okay, so our next polling question here, which of the following charitable or gifting strategies are you considering before year end? Okay, I'm just giving everybody a chance to answer here. Okay, and let's go ahead and keep moving because I know we have 15 minutes left.
Okay, so if we go to the next slide. Okay, so wealth transfer and estate planning. So while giving to charity gets you a current income tax deduction, there is a bigger picture that you may need to consider depending on the size of your estate. So the estate tax applies to couples with wealth exceeding $27.98 million of value if you were to die in 2025, or $13.99 million per person if you are single. The amount increases to a flat $15 million per person, or $30 million for a couple in 2026 under the One Big Beautiful Bill Act. So for 2025, the $13.99 million per person applies to both gifts you make while you are alive and the amount you pass on to your heirs when you die. It is a combined total amount of gifts while alive and transfers after you die that are gift and estate tax free. So some gifts that you can make while you are alive include gifts of cash or securities, partnership or other family business interests at a discount. You could forgive interfamily loans, or you could structure part sale and part gift transactions. So grantor trusts may be an impactful way to make gifts. So grantor trusts are disregarded for income tax purposes, so you still pay the income tax on the earnings of the assets transferred to these trusts. If a grantor trust is irrevocable, the trust is outside of your estate. If you continue to pay the taxes on the income generated by an irrevocable grantor trust, the trust assets can accumulate without being diminished annually by the income taxes due. This strategy can simultaneously increase the assets and trust outside of your estate by not paying income tax, while decreasing your estate by paying the taxes on behalf of the trust without creating an additional gift to the trust. It's a win-win. So grantor trusts and the powers that they contain are very complicated, so forming and administering trust of any kind should be done alongside your estate planning attorney. Valuation discounts are a great tool to use on family entities like family limited partnerships or S or C corporation stock of a closely held business. The IRS allows you to decrease the value for gift tax purposes if you transfer a minority interest in the company for both lack of control, which is a minority interest that generally cannot impact entity level decisions like demanding a cash distribution of profits, and a lack of marketability, which means there generally isn't much of a market for minority interests in a closely held entity that owns family assets. So the combined discounts on the value of the gifts of a family limited partnership for lack of control and lack of marketability can get up higher than 25%, which discounts the amount of lifetime exemption you use to transfer an interest to a family member. You should speak with your tax advisor if you would like to use this strategy, as it incorporates evaluation of the entity, tax reporting, and income tax reporting on the entity's tax return for these transfers of interest. Lastly, ahead of year end, you should review your will and trust structure. This includes your overall estate plan. So does your estate plan still make sense based on your current family makeup and your legacy goals? Did you have any major changes to your family structure since updating your estate plan, like the birth or death of a spouse or child, a marriage or divorce, or a change in inheritance that you received that may impact your overall estate strategy? Make sure to speak with your estate planning attorney, as these major life events occur, to ensure your plan is up to date and reflects your current intentions. If you've created trusts in the past year, please make sure that the assets that you've intended to gift to these trusts are properly titled in the trust's name, not in your name. If the trust that you intended to gift to the trust are not titled in the trust's name, the assets will still be included in probate if you were to die. If you make annual exclusion gifts to trusts for the benefit of your children or directly to family members, the 2025 annual exclusion amount is $19,000 per person. If you are married, the combined gift that you and your spouse can gift to an individual or trust is $38,000. The annual exclusion amount does not increase in 2026, so it remains at $19,000 per person. If your trusts have distribution powers, review the need to make distributions by year end. Some trusts require annual distributions, and other trusts have optional distribution powers. If your family has a trust that pays its own tax, so it's not a grantor trust, a reminder that trusts hit the 37% highest tax bracket once the trust has net income of $15,650 in 2025. By making distributions out of the trust to beneficiaries in lower tax brackets, the overall tax liability paid on the income generated by the trust may be lower in total by making distributions out to the beneficiaries. So speak to your tax advisor if you have any questions about whether or not your trust should make distributions by the end of the year and the tax impact of leaving the income of the trust or distributing the income to the beneficiaries. So the main takeaway of what you can do now. So the main takeaway from your wealth transfer and estate planning is to schedule a year-end review with your estate planning attorney. It may make sense to also include your tax advisor in those meetings, since there may be follow-up items that impact tax reporting or tax planning for both you individually and for your trusts. Okay, next slide. Okay, life insurance and liquidity planning. So life insurance is a great tool to use for legacy planning during your income generating years if one family member passes earlier than expected. It is also an important tool to use if you think you'll have a taxable estate, which would be over $30 million in 2026, and you'll need additional liquidity to fund all or a portion of the estate taxes without selling other closely held assets in your estate. So irrevocable life insurance trusts, or ILITs, are a tool used for funding the premiums for a life insurance policy intended to reduce your estate tax exposure. If the ILIT owns the insurance policy and pays the premiums, the death benefit of the insurance plan is not included in your estate as an asset. On the other hand, insurance policies owned in your name individually are included in your taxable estate. You can fund the annual insurance premiums through annual exclusion gifts of $19,000 per person, or $38,000 for you and your spouse if you're married. These gifts should be disclosed on your annual gift tax return, even if they are at or below the annual exclusion amounts, to document the transfer to the trust. A reminder that if you are doing life insurance planning and have an ILET in place, you should continually review the policies in force and ensure that the policy continues to align with your overall estate plan and provides the intended level of liquidity needed for the value of your estate. So as lifetime exemptions have increased precipitously over the past decade, the need for life insurance policies to cover an estate tax liability may no longer be needed if you no longer have a taxable estate, as lifetime exemption increases to $15 million per person in 2026. You should speak with your estate planning attorney and insurance advisor to ensure your plans are in alignment with your overall needs. So what you can do now, as we get to year end, you should ensure you fund your annual exemption amount to cover insurance premiums. You should verify the structuring of the policy in ILET to ensure the death benefit will be outside of your estate, if that makes sense, and review the life insurance death benefit amount to determine if the policy size is still right for the value of your overall estate. Next slide. Okay, so coordinating your advisory team. So throughout our discussion today, we've mentioned planning strategies that incorporate others in your advisory team in addition to your tax advisor, which includes investment advisors, planning attorneys, insurance advisors, and others in your business and personal entity structures. Having a clear line of communication between yourself, your advisors, and between those in your advisory team may increase the effectiveness of your overall income and estate tax plan. The more that your advisors on your team have an understanding of your intentions and changes that you have made or plan to make, it will increase the efficiency of the transfers that you're making, and it will ensure that all changes are properly documented and reported for income and estate tax purposes. If your transfers aren't correctly documented and reported, it could result in the loss of the benefits of all of your intentional planning. So, having a collaborative advisory team will pay off in the long run by increasing the effectiveness of your legacy planning. So as you get close to your end, it may be a good time to coordinate a planning meeting with your core advisors, especially if you are considering making larger changes to your estate planning structure or have made a large change in recent months. So once the year closes, it is important to recirculate all changes that occurred in the past year to all advisors so they have the information for their files, if they don't have it already. If the purpose of your meeting with your advisory team is to more broadly share what you've done or what you've already done, it may make sense to defer that meeting with your team until the first quarter of next year to ensure all changes in your plan through December 31st, 2025 are clearly communicated. While changes to your life, such as birth, marriage, and divorce, are important to your income tax team, they are also very important to communicate to your other advisors, including investment advisors, estate planning attorneys, and insurance advisors. Ensuring all are aware of these changes will encourage important conversations that may require changes to your estate plan or require a change in beneficiaries to a retirement plan or a life insurance policy. While discussing changes in your life may not be the most comfortable discussion to have, the importance of the changes that come from these discussions will have an impact for years to come, ensuring that the correct individuals benefit from your plan. Okay, so let's go to the next slide. Okay, so building your personalized year-end checklist. So as we finish our year-end planning discussion today, I wanted to touch on a few ideas to be thoughtful of on your year-end checklist. So as a review, so for income and investment review, consider harvesting capital losses to minimize taxes on net capital gains, and also consider deferring income into 2026 and accelerating deductions into 2025 if you have some control over the timing of those items. For gifting and charitable planning, consider accelerating charitable contributions or bunching charitable contributions into 2025 to maximize the tax benefit of your deductions by avoiding the 0.5% haircut and the 35% maximum tax rate benefit that begins in 2026 under the One Big Beautiful Bill Act. Also, make annual exclusion gifts of $19,000 per person by year end if that's something you would like to do. For estate and document updates, consider updating your estate plan if there have been any major life changes in recent years. If you have done any major estate planning in 2025, make sure to share the changes with your advisory team, which includes your tax advisor, investment advisor, estate planning attorney, and insurance advisor. For retirement and conversion deadlines, remember to ensure to make your required minimum distribution by December 31st, 2025 if you are 73 years old or older in 2025 to avoid late distribution penalties, and consider funding a qualified charitable distribution as part of your required minimum distribution to minimize the taxability of your required minimum distribution and maximize the impact of the gift to charity. This should be done on or before December 31st, 2025. If you'd like a good reminder of the many topics that we touched on today, I would like to encourage you to download the Armanino Year-End Tax Planning Guide for individuals and families, which will be shared in the Zoom chat. This guide will provide more context for the items we discussed today and may have additional ideas that may be important to you to your year-end planning discussions. Back to you.
Thanks so much, Jonathan. Okay, let's go on to our next and last polling question. So as you approach year end, which area do you most want guidance on? Once we have everyone answer this, I'll close us out. And while everyone's answering, thank you so much to Jonathan and Debbie. And if you guys ever have any questions, you can feel free to reach out to our presenters. You can go to our website to do that. Okay. I'll go ahead and still have a couple people answering, so I'll leave it up there for a sec. Okay, let's go ahead and end that poll. And then I can close us out. So thank you everyone so much. Again, feel free to reach out to us via our website. The link was just shared. Again, check out the guide that Jonathan mentioned. It's super helpful, covers a lot of the information that they talked about today, but a little bit more in depth. And then always follow us on Tax at Armanino on LinkedIn. We have a Tax Edge newsletter that we post with all of our thought leadership and any, major tax updates. So thank you everyone so much, and we will send the recording and slides after this meeting, and they'll also be published on our website as well. Thank you everyone. Have a great day.